Good morning, class. Thank you so much again. We are meeting today, Economics Grade 11. We just want to look at accounting aggregates. We want to look at different methods of calculating GDP, the total production that has taken place within the borders of a country over a period of a year. There are different methods that are used in calculating that. So I have got some good questions that I have attached here, which we are going to work together as a class in order for us to demonstrate these whole concepts. So now I just want us just to follow these questions, just be closely attentive to these questions so that we don't lose or we don't miss each other. So now what happens is that I want us just to go straight to the questions, and we are going to work out. As you can see, these questions are attached here. They are so technical and very uh, practical in our end of year examinations. So without wasting any time, let's just quickly answer the questions. Double counting is a problem that occurs when dash method of calculating GDP is used. So when calculating GDP, we may have a problem of double counting. So what is it that can cause double counting? I want you to understand that in terms of this, it can only take place when we have got a production method. Production method can cause double counting to be a problem when it is used in calculating GDP in the production method or production value method. I want you to understand that if intermediate goods are counted together with the final goods, we may have problems whereby to say the value will be counted twice. If intermediate goods are counted with final goods, the value will be counted twice. So to avoid double counting, only value added on each stage of production is what is included. We only add the value added at each stage of production in order to avoid double counting. So production method is the one that causes what? That causes problems, or that might have problems when when calculating GDP. And then in comparing the GDP of one year with that of another year, the dash is used. What is used in comparing the GDP of one year and another year? What method is used? In that case, I want you to understand is we use GDP at constant prices. GDP at constant prices is used. GDP at constant prices is used in order to compare GDP of different years. So what you need to understand is that GDP at constant prices, it removes the effect of inflation. Why do we use this one? Why this one? It removes the effect of inflation. It removes the effect of inflation. I'm sure that you understand inflation is the consistent increase in commodity prices at the expense of the current value. That prices of commodities, they keep going up. However, the value of the currency does not change. So now what happens is that the money would buy less. So what happens is that it shows the real increase or decrease in production. This GDP at constant prices, it actually shows the real increase or decrease in production. That makes it accurate for comparing different years. It actually shows real increase. It shows real increase or decrease. It shows real increase or decrease in production. In production, what happens therefore is that therefore it is accurate to compare different years, making it accurate to compare different years, making it accurate to compare different years. That is why we use GDP at constant prices. It removes the effect of inflation. It takes away the effect of inflation. So the answer is C. In market value of all the final goods and services produced in an economy during a year, the market value of all the final goods and services produced in an economy during a year or during a period of a year, we call that GDP. It is gross domestic product. It is gross domestic product, which we can see that gross domestic product, it actually measures the total market value of all final goods and services produced within a country in a given year. Over a period of a year, we are saying total value of final goods and services is calculated. Total value of goods and services. Total value of goods and services produced within a country that are produced in a country over a period of a year. We calculate that, we are saying that is calculating GDP, and then the total value of remuneration that the owners of factors of production receive for their share in the production process for a specific period of time. Total value of remuneration. Remuneration, we are talking about compensation. We are talking about payment, that which are the owners of factors of production. Remember, we said that who are the owners of factors of production. This has been mentioned that owners of factors of production, these are households. We say this is consumers. Consumers are the owners of factors of production. So now, what I want us to understand is that what is the total value of remuneration? So that must be known as gross national income. It is known as gross national income. Gross national income. It is gross national income. It is gross national income, which actually measures total income earned by the country's residents. Total income earned by the country's residents. Earned by a country's residents. We call that country's residency. We call that what? Residence, including wages, rent. This can be in the form of residency. Like we talk about wages, we talk about rent. It can also be in the form of profits or interest. We say that factors of production are paid in different formats. They are paid in different formats. We have got different ways of measuring or payment of factors of production. So that which remuneration which owners of factors of production receive is gross national income, which actually measures the total income earned by a country's residents through wages, through rent, through profits or interest. That is what we call gross national income. And then question number 2, it says, what is the purpose of the residual item in the expenditure method? We talked about different methods of calculating 2.1, different methods of calculating GDP. So the residual value or the residual item in the expenditure method, what does it do? It's actually the residual value, the residual item, it actually measures or it ensures the total expenditure equals total income in the national accounts. It balances total expenditure and total income in national accounts. it balances uh it, it balances total expenditure to what? Total expenditure uh to total income within our national accounts. In the national accounts. So that is the reason for residual item. So what we need to understand is that uh, the residual item, it actually adjusts for statistical differences, so that when we calculate, so that GDP, when calculated using different methods, balances correctly. You need to understand that it actually adjusts for statistical differences. In a case that when GDP is calculated using different methods, they actually balances correctly. That is what you need to know. NB, in terms of this, I'm just making it clear that it adjusts it adjusts statistical it adjusts statistical differences, so that GDP, so that GDP uh, when calculated with different methods, with different methods, it actually balances correctly. It balances correctly. That is that it balances total expenditure to total income in national accounts, which actually we have stated here. So please note that that is the reason for residual item in the expenditure method. So making provision for statistical differences when GDP is calculated with different methods is so that it can balance correctly. And then give two examples of taxes on production, different examples of taxes on production. Examples of taxes on production, we can just give here to say that different examples of taxes in production. We can talk about VAT, value added tax. I'm sure that we have heard of this one, value added tax. Value added tax, which is one form of this value added tax. I'm sure that you know that is called what? That is called VAT. And then we also talk about exercise duties. Exercise exercise duty, which is some levies or charges on goods that are entering within the borders of country. These are supposed to be paid in order to promote internal production, or to promote localization of industries and business within the borders of the country. So value added tax, I'm sure that we have heard that in South Africa is at 15%. So it is one other form of tax on production. Value added tax is one form of production. I mean, one form of tax that we can find there, VAT, which is a very common example of tax that we have when we look into our South African economics or South African economy. Uh, One question, number 3: why is subsidies subtracted in calculation of gross domestic product? Why do we have to calculate, to subtract subsidies in calculation of in calculating GDP? So the reason is that subsidies are subtracted because they lower the market price of goods and are not payments for production. They are not subsidies, are percentages, levies, or support that is given by government to businesses in order for them to have finance or to access funding. So to access finance or capital for business. So they are subtracted because they lower the market price, because they lower market price, they lower the market price of goods and are not payments for production. They lower the market price of goods and are not payments for production. They are not payments for production. They are not payments for production. What you need to understand is that these, we say that to move from factor to factor price, we add taxes and subtract subsidies. That is one thing that you need to know. In order for us to move from factor cost to market price, factor cost to market price, we need to add taxes and subtract subsidies, because subsidies, they are actually there to lower market price. They are not payments for production. Hence, they must be subtracted from gross domestic product, because we are looking at when we talk about market price, we know that this actually calculates the income that can be made from the production that has taken place, or the market price. It identifies the total money that can be uh, harvested or that can be made when goods are sold. That is the selling price of what, of goods, the price at which consumers are prepared to pay for the products that are on the market. So we don't have to add subsidies. Instead, they are subtracted, as they are not payments for production. They are actually given for free, or they are support structures put in place by government. And then number 2.4, why are intermediate goods and services excluded? Why are intermediate goods and services excluded when calculating the value of GDP? Why are they excluded when calculating the value of gross domestic product? I want you to understand is that this comes back to the same question that we have answered before. Intermediate goods and services are excluded when calculating GDP. We have answered a question that identifies reasons of or a method that can cause double counting. So in order to avoid double counting, we exclude goods and services that are in intermediate goods and services. So the reason is to avoid double counting, to avoid double counting. We do that in order to avoid double counting. Intermediate goods are used to produce final goods. They are still in the production process. They are still to be used to produce final goods. So including them would overstate GDP. That is one thing that you should understand. These, we are saying the intermediate goods are used to produce final goods. They are used to produce final goods. They are used to produce final goods. So including them would cause overstating of GDP. Hence, including them would cause overstating of GDP. GDP would be overstated because we are saying they are going to be used continuously in the production process. So they are used to produce final goods. These intermediate goods, so including them, would cause overstating of GDP. Name two main economic sectors when calculating two main economic sectors when calculating GDP. Uh, this we can talk about the primary and secondary sector. I'm sure that we know we are saying primary and secondary sector. Primary and secondary sectors are the ones that are the main sectors that we talk about when calculating GDP. We talk about production in the primary sector and then production in the secondary sector. We are saying they are the two main economic sectors we need to consider when calculating GDP. And then name two types of assets that make up gross fixed capital investment. Uh, Gross fixed capital investment, it is actually made up of one. It is made of different. We say one, we do have fixed assets. We have got fixed assets. The fixed assets, this can be, for example, we talk about buildings or machinery. Buildings or machinery can be examples of fixed assets. We can also talk about number two. You can talk also of infrastructure. Infrastructure that can be roads or bridges, like roads or bridges. There are two assets that make up gross fixed capital investment. So we need to know these again. They are the two types of assets that makes up gross fixed capital investment. You understand? So I want you to basically take note of this. So number three, we have got a table and we need to answer the question that follow. We are given item and amount, which is given, we are given table that has got amount, which can be in millions or whatever. So now what needs to be understood here is that consumption expenditure by households, government expenditure, gross capital formation, and then we are saying added together, we have got gross domestic expenditure. And then our exports on goods and services, we have got that, which can also have imports on goods and services, GDP at market price, which is given there. So when given this information, question would come, which you are asked to, I say, identify the method used in the above table. Identify the method used in the above table. It is what method of calculating GDP that is used in this table. So you need to note that this is, as you can see, we are seeing that this is an expenditure method or a spending method. As you can see, we are talking about expenditure. We talk about expenditure by households, by government, and then we also have gross domestic expenditure. So this identifies, it is called expenditure or a spending method. Expenditure or a spending method. This is expenditure or spending method, which I want you to note that that is the method, because as you can see, it calculates GDP by adding all spending in the economy. GDP is calculated by adding all spending in the economy. We talk about consumption. GDP is measured by adding all the spending in the economy. We have got consumption plus, we have got consumption is added, and then its consumption. We also have government spending, consumption plus government spending. We also have investment plus investment. and also exports minus imports plus exports plus uh, exports minus imports. This actually identifies that this is an expenditure method that is given in this reference. It's an expenditure method that is given in this case, as you can see here. So now, next question is saying, name any other method that can be used to calculate GDP at market prices. GDP, name any other method to calculate GDP. We can talk about any, we have got one. We can talk about the income method. I'm sure we also know the production method. The production method, which we say it is also called value added method. It is also called value added method. So these are other methods that we can use to calculate GDP considering market prices. These are also other methods that we can use to calculate GDP using market at market prices. So let's just go to the next question. The next question says, explain the following components. Explain the following components. I just have to say GDP using the expenditure method is equals to consumption plus government. We are saying household consumption plus government plus investment. So it is gross domestic expenditure, gross domestic expenditure, that is given as GDE, gross domestic expenditure. So we also have, I want you to know that this is total spending within a country, which is total spending within a country, spending within a country, total spending within a country. That is what we call, that is what we mean by uh, gross domestic expenditure, total spending within a country. So now we have got C, which is equals to, C is equals to consumption spending by households on goods and services. Consumption by households, this is on goods and services. Consumption spending by households on goods and services, on goods and services. We also have G, government spending is equals to government, that is equals to government spending. That is equals to government spending by government on goods and services as well. And then we have got I, which is equals to it also means investment, spending on capital goods and capital goods, machinery, buildings and equipment. So it is what? Spending on capital goods, spending on capital goods, spending on capital goods. This can be, I want you to note that we are talking about machinery, capital goods. It has got to do with machinery. It talks about equipment. It talks about buildings also. these are examples of capital goods that we need to actually look at. So some of these are quite clear points that I want you to just easily and quickly grasp, because we are working on revision, answering questions of things that we have already uh, worked on before. So we need to look at that, and then briefly describe the term gross domestic expenditure. Uh, uh, Gross domestic expenditure, it actually is the total amount of money spent on final goods. This is total amount of money that is spent, total amount of money that is spent on final goods and services, spent on final goods, final goods and services. This is spent on final goods and services uh, within country during a specific period, within a country, within a country during a specific period, over a specific period. We call that gross domestic expenditure. Final total amount of money that has been spent on final goods and services within a country over a specific period. So I want you to note that that is what we mean by uh, gross domestic expenditure, which is within the country, what has been spent by various participants within an economy of a country, which is actually supposed to be noted that must be over a specific period. It tells us the total domestic expenditure. And then calculate GDP at market prices. Show all your calculations. So one thing that we need to do here, first and foremost, is to understand that GDP at market prices, we are saying GDP is equals to, we say GDP, gross domestic expenditure, plus this must add export value minus imports. Therefore, when you do that, we can say GDP is equals to, we are saying gross domestic expenditure is on our table. When you go back to our table there, if we come back to our table there, we say that this is going to be 360,000 gross domestic expenditure, which is given here. Gross domestic expenditure is 360,000. It is given, we can see that it is given in this case, 360,000, which is according to our formula that we have said. So GD, we are saying gross domestic expenditure is 360,000, 360,000 plus, we are saying export minus imports. Our exports, we are given also in question there. Our exports are given, the exports on goods and services is 45,000. And then imports on goods and services is what? 65,000. We are using also these two. We are also using these two in the calculation that we are doing. Exports minus what? Minus imports. So that can give us what we are working on plus exports, which is this plus, which is 45,000. It's 45,000 minus 65,000 minus 65,000. Obviously, this gonna give us to say 360,000. 45,000 minus 65,000, we get minus what? Minus 20,000. This is plus minus, this is plus and minus. which I think mathematicians, you guys, you understand that when we deal with this, what happens when we have got these signs together, these are going to convert to what? To this is going to be a minus what? Minus 20,000. So I'm saying this one, plus and minus, it is supposed to give us 20,000. It gives us uh, a minus. So if you look at this one, what is happening is that this is going to say this is close to 360,000 minus 20,000. That would give us the final answer there, which will give us the final answer. That is going to give us that would give us 340,000. 340,000. And then we can say that that is what? That is our GDP. That is our GDP. I'm sure that you can see and you can agree with me that gross domestic expenditure plus exports minus imports, which would give us these values that I've given you there, so that we are able to follow and make sense of them. So we go to the next question, which also identifies another national accounts aggregate in South Africa, summary of gross domestic product, which is in millions in 2016. This is in millions. Which year is it? 2016, which is in 2016, and compensation on employee and also net operating surplus consumption of fixed capital. We are also given gross value added at factor cost, gross value added at factor cost. We have got also taxes added on production, other taxes on production and subsidies on production, gross value added at basic prices, which is also given. And then we have got gross domestic product at market price, which is not calculated. So the question says, identify the method used in the table. The method that is used here, it is actually the income method. It identifies the income method. It identifies the income method. What is happening? It uses compensation for employees is there. Why do we say that? Because it uses, we have got compensation of employees. It uses compensation of employees, which we have there. We have got compensation of employees, operating surplus. Operating surplus is also given here. Operating surplus is given here. We also have compensation of fixed capital and consumption of fixed capital. Consumption of fixed capital. So what does this mean? All these things that we are seeing here, class, what it means is that these all things are income earned from production. All of them, they are income earned from production. If you can look at them, operating surplus, consumption of fixed capital, consumption, compensation of employees. These are also all showing incomes earned from production. And then identify the factor of production in the table above that receives the biggest portion of national income. Which one component factor in the production that has received the biggest portion of national income? The one that have received the biggest portion of national income, if you can see there, we can look at the figures that are there. We have got 2,051,326. We have got, we are saying if you can look at that, it actually shows you that labor was paid a lot. Labor compensation of employees. If you can look at this, the amount that is allocated or that is apportioned there or that has been spent there, it identifies that it shows employees, which is to say that labor is a composition of employees, which is the factor of production is what is labor. The labor is the one that is we are talking about, which is what employees. But one thing that I want you to note, class, here is that the question is saying factor of production. So please be observant. Be observant because you might run to answer the question, but you are answering it wrongly. The question wants you to identify the factor of production, where you see that compensation of employees received 2 million. So I'm saying compensation of employees is the highest, but in any case, the factor of production is the one that you need to look at. Compensation of employees, it goes for what? It goes for factor of labor it is a factor of labor. It's a factor of production as labor that you must not miss it, which is given in according to this scenario. Briefly describe the term basic prices. Describe the term, describe basic prices. Basic prices. What is basic prices? Uh, what producers actually earn from their goods is what we call basic prices. What producers actually earn for their goods is what producers earn for their goods. What producers earn for their goods is what we call basic prices. We are looking at these as basic prices. We are saying they are prices received by producers, excluding tax on production. Prices. We can say prices received by producers, excluding on excluding it actually exclude taxes on products, but including subsidies. Prices received by producers, excluding taxes on products. Taxes on what? Excluding taxes on products, which we are saying these are prices received by producers. These prices are received by producers, uh, which we say that they exclude uh, taxes on products. However, they consider subsidies. So that is what you need to understand. What producers earn for their goods is what we call basic prices. And then number 4, uh, briefly explain how subsidies can influence production. How do subsidies influence production? This must be known that subsidies, the lower production cost. Subsidies, the lower production, costs. And then as you know that production costs are lowered, uh, what do they do? Which at the end of the day, which encourages firms. It encourages firms to produce more goods, to produce more. Firms can produce more. They can sell at lower prices, they can sell at lower prices, and then at the same time, they can also employ more workers, 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 employ they can employ more workers. At the end of the day, this increases total production in the economy, uh, causing an increase in total production, an increase in total production in the economy. Total production can be increased. As you can see, this is happening because subsidies are causing the lower production costs, because businesses or firms have got a surplus or have got an injection of money in their businesses so that they can produce more. They can now be able to sell at lower prices because the production costs were low. So in order for them to maximize on that, they sell at lower prices. At the same time, production can be improved or can be increased by employing more workers, where at the end of the day, the economy can be made better. That is what happens there. And then 4.5, calculate the GDP at market price. GDP at market price. GDP at market price. What we need to understand is that we can look at this as to say GDP at market price. GDP, it is given as MP. GDP at market price is equals to GVA at basic price, which is plus taxes, plus taxes, plus taxes, and then we say minus subsidies, minus subsidies. That must be known that, and then what we know is that gross value added on basic prices, gross value added at basic prices, and then taxes on products, also subsidies on products. These are also given when we look on the table that we have been working on or on the attached information sheet. We are saying this, we want to look at gross value added at basic prices, gross value added at basic prices, gross value added at basic price. I can give it that you can see gross value added at basic price, gross value added at gross value added at basic price, which we say that it can be given as BP. That is given there, gross value added at basic price. And then we also have our taxes, which we are also given that we have got taxes plus taxes, which is given there also, taxes on products. Taxes on products is given also here that we have got taxes on products, which is identifying, which is taxes on products, which is also there. And then we have got subsidies, our subsidies, which is also given as to say, our subsidies is also given as to say that subsidies on products is also given that our subsidies on products is 16,415. 16,415 is our subsidies. So what we need to look at, or what must be understood, is that we are working on these figures: gross value uh, added, gross value added at basic prices, which we are given, and also we work with the taxes on products, 481,059, 480, 480 is 80, 484,059. So we are working with the number 1, 2, and 3 in order for us to calculate, the question that is given here, for us to calculate this. So we are given these figures like I've shown you. The gross domestic product at market price is equals to, we are saying these figures are given there like I've shown you. So in exam, you need to give this. We are given 387, 387, uh, 387, 1224, 1214, which is given there, plus our taxes, which I have shown you again, that is what, 484, 059, which is given there, minus the subsidies that are also given there, which we said is what, is 16,415. So when we do that, we can be able to put it through the calculator. That will give you an amount of 4335, 4 43 35 85 858. So we are saying our GDP at market price, this is our GDP. Our GDP is given to say that we are having those figures. So please, not like I said that what you need to know is that I had stated it for you to say when calculating this question, you must always start by what? By stating the values that you have, to say our gross value added at basic prices, gross value added at basic prices, which is given to say that it is that amount, which is 3 million something. 3 is 3 million. This 3 is 387, 387, 1214. And then we also say that you also say taxes on products. Taxes is equals to, which is also given there to say that is that number that we say 484, 050, 059, and then we say subsidies. Subsidies is equals to 16,415. 16,415, which I'm saying when given this, when you state these figures, you are therefore able to work them and substituting them in your formula as I've shown you here. You can be able to put them in your formula and then work them equally good. Here we are just taking the values that we have, GV, gross value, and then we work all those gross value added on basic prices, taxes on products, subsidies on production. These things are stated on our table that we are working on there. So I just took the figures and then substituted them into these indices that are shown on the table. And then the question next is saying, it says differentiate between real figures and nominal figures. Differentiate between real figures and nominal figures. This nominal figures is equal to money value today, and then real figures, we also say that the real figures, it identifies money value after removing inflation. So in other terms, I want you just to know that nominal figures, nominal figures, and then we can say real figures, and then we put that like that. So in other words, we are saying nominal figures measured at current prices. They are measured, these are measured, they are measured at current prices. They are measured at current prices and not adjusted for inflation. Not adjusted. They are not adjusted for inflation. They are not adjusted for inflation. That is one. And then if we talk about real figures measured at constant prices, they are measured at constant prices. They are measured at constant prices, and at the same time, what happens is that they are measured at constant prices, and then what happens is that they actually shows the true purchasing power, which is adjusted for inflation. They are and are adjusted. They are adjusted for inflation. They are adjusted for inflation so that they shows real purchasing, they show true purchasing power of the currency. They show true purchasing power I think we are able to understand and to see what is all this difference is all about. So nominal figures are at current prices, not adjusted for inflation. They are not adjusted for inflation, and real figures are measured at constant prices, which are also adjusted for inflation. They are adjusted for inflation, which also makes sure that they are adjusted for inflation, which also makes it easy for that point to say that they show true purchasing power of whatever being calculated. And then in simple terms, which I say that nominal figures are money value today, and then real figures, they actually show money value after removing inflation. So number 5.2, why is capital formation important to South African economy? Why is capital formation? Why is capital formation important for South African economy? We need to understand that it is important. It increases production capacity. It helps to increase. It increases production. It increases production capacity. That is one key point that I want you to note, that more machines, factories, and technology can be acquired there. We can also talk about it creates jobs, reducing unemployment. It creates jobs and reduces unemployment, which is a very important point also. It reduces unemployment. We can also talk about it promotes economic growth and improves living standards. Promotes economic, it improves economic growth. It promotes economic growth and improves living standards of people. Improves living standards of people. So these are very important points that we can actually see the reason for capital formation in a South African economy. Jobs can be created, unemployment reduced, at the same time production capacity it is improved. If capacity improves, therefore more people has to be employed, and that would be a very good point to take note of. uh, differentiate between gross domestic product and gross national product. Differentiate the two. Differentiate between gross domestic product and gross national product as main aggregates in the economy. This also must be understood that when we talk about gross domestic product and gross national product, what we need to look at, or what must be understood, is that gross domestic product, which is GDP, what it does is that it measures total production within a country's borders. It measures total production within a country's borders, includes foreign companies operating within that country. It measures total production within the borders of a country, within the borders of a country, including foreign companies that are operating, including foreign companies operating within the country. That is what we mean by GDP. It actually measures total production, uh, uh, including the foreign companies that are operating within the country. And then gross national product, well, what happens is that gross national product, what does it do? Gross national product, what it does is that gross national product, it actually measures total production by a country's citizen, measures total production by a country citizen, includes income earned abroad by locals, income earned that is earned abroad by locals, income earned abroad by locals. It is part of gross national product. It is part of gross national product. And then it excludes income earned by locally, which is income excluding income earned locally by foreigners. Excluding, it excludes excluding income earned locally by foreigners. Income earned locally by foreigners, it is excluded. So we can see that GDP, it measures total production. It measures total production within the borders of the country. And then all the companies that are operating in the country, even if they are foreign companies, they are also included in terms of gross domestic product. It accounts for total production that is happened, or that has happened within the borders of the country, irrespective of saying who produced that, who have made that production. So contrary to that is that gross national product is also of total production, which of course has been produced or has been made by a country's citizens, including income earned by earned abroad by these citizens or by these local South Africans working in other countries, the money they make from other countries, we include it under gross national product. And then we also want to understand that it excludes income earned locally by what? By foreigners. Money that has been taken away by foreigners to their country. We define that as what? It is actually not accounted. It is minused. It is excluded. That is the difference. That's the difference that we need to understand with respect to this. And then 5.4, explain the conversion from factor cost to market prices. The conversion from factor cost to market prices. What happens there is that we are saying it is supposed to say factor cost to market prices is equal to factor cost plus taxes on products. It is factor cost. This is cost to, it is cost to factor cost. It is cost to factor cost plus taxes on products plus taxes plus taxes on products plus taxes on products. So what happens is that we add taxes because they increase prices. That is therefore saying, I want you to note that taxes are added because they increase prices. Taxes are added because they increase prices. They increase prices and then subtract subsidies. What happens because they reduce prices? Subtract subsidies because they reduce prices. They reduce prices. That is one thing that must be known. So what you need to understand is that market price is what consumers actually pay. Market price. Market price is therefore what consumers actually pay. What consumers actually pay is what you call market price. What consumers actually pay is what you call market price. So, Classy, I thank you so much for your time, and I wish you all the best in this what you call in this term, and also for you to understand economics good and sound enough. I want you to just note that uh, when we talk about nominal, it is not adjusted for inflation. I want you also to know that real means that real figures, they are adjusted for inflation. Gross domestic product, its production inside the country. Gross national product, it is actually production by citizens. Factor cost, factor cost, I also want you to know that that's what producers receive. Factor cost is what producers receive, and market price, what consumers pay. Those variations, you need to take note of them. There are some core definitions that are tested or that are asked at grade 11. What are these things? Core market factor, factor cost, what producers receive, market price, what consumers pay, and real price adjusted for inflation, nominal price not adjusted for inflation. Some of these I just want to keep reminding you so that when you come back to this topic, you won't have problems. I want you to just share to friends, share to classmates, share to uh, everybody whom you know who is doing economics. Let them know that Metric Hub has come for the rescue of everybody. Let's meet now. Let's work out this. And I promise you that with Metric Hub, Metric is going to be simplified. We are here to ensure that we are to support, to progress, and we get our NSFAs. Let's not lose them unnecessarily. Join Metric Hub now, subscribe, click on join, and follow the prompts that are there in order for you to please not miss anything that Metric Hub is there to support for you. Have a good day. Thank you.